Joining us right now is Ron Landry, Head of Product and Canadian ETF Services at CIBC Mellon. Ron, it's great to be here with you.
Yes, thank you.
So Ron, you're here, you're like the great overseer of the industry and all of the activity that's going on. With your view from 30,000 feet, what do you see happening in the ETF space?
It's an interesting space. You know, I think there's a lot more now happening in this space. We have asset managers who historically may not have looked at ETFs as a solution, looking into the space. So even if they don't get into it, they are looking. They realize that there are assets to be had from investors who aren't interested in traditional mutual funds. So they want to buy ETFs. Whether you have a good product or not, if it's not offered in that vehicle, chances are they'll look elsewhere for a similar product. So we're seeing a lot of that happening. We've seen some startups come into the space. They, I would say, are struggling to gather assets. ETFs, no different story than mutual funds. Distribution counts.
It's a very competitive space.
It is,
and you see the momentum is continuing. Has it accelerated, or is it the same? Or
you're definitely seeing decent flows. I think in May we hit the all-time record for flows at 4.3 billion in Canada, and the rest of the global market was actually down. So we've had two back-to-back good months, April and May. I think we're surpassed 2017 from a growth perspective in inflows. So you know, unfortunately for the bulk of it, the assets are going to the top players, obviously. There's comfort in those names, and that's where the money is flowing, making it harder for the bottom half of the table to sort of gather assets in that space. And the startups are really struggling. You're not seeing a whole lot of flow go their way. And that's, you know, either they haven't launched a family of product, they've launched one or two, and you know, advisors don't want to sort of put their investors into products that may not be around in the next 2 or 3 years, right? So they're looking for stability from that standpoint. And obviously the shelves are getting shorter and shorter, and distribution's getting harder and harder. And so,
is there any distinction? Like, do you see a lot of continued momentum in index funds, or is there a growing momentum in active ETFs? Is that?
I would say there's a lot more activity in the active side.
Right.
I'm going to get my numbers probably backed up a bit, but I think 6% of the launches have come in the active space, and I think 40% of the flow is going into active. A lot of more thematic type products in the active space that are coming. I don't know that we need any more passive index products. There's a lot of them. I think you can sort of pick your ideal service provider or ETF provider in that space and sort of run with it. And other than fees, they're pretty well.
I'm sure there's been a lot of competition on compression, cost compression. Even seeing, actually, I'm not sure if it's in Canada, but definitely in the U.S. there's been even a launch of an ETF
that pays you. Yes,
pays you.
So it's a great gimmick. Because that's what it is, right? Like. There's no asset manager
but that just gives you an idea of how competitive it is, definitely. And then active ETFs, active fixed income or active equity, which is seeing more activity.
I think we're seeing at this point a good mixture. I would say it's probably, I'm going to get this wrong, but it's probably about 50-50 on the launch side right now. Obviously, active. Globally, it's probably more fixed income based, but in Canada, just the way that we're structured from a regulatory perspective makes launching an equity active ETF quite easy, and so there's the same appetite to sort of launch the same products.
Sure. Now, in the active space, that includes, of course, the smart beta and the factor products, factor solutions are coming out.
And a lot of
it's not all purely. There's also like
a hybrid,
actively managed portfolio ETFs as opposed to smart beta or rules based.
Correct. And I think you're seeing a lot of more in the thematic space. It's definitely equity based, actively managed sort of themes that are coming there. But once again, you're still getting passive index-based products as well.
So what's happening now with the changes in the rules last year and the introduction of new allowances for alternative products, alternative liquid alts? What do you see happening in that space?
There is a provider that's come out, and I'm going to forget their name, but they've announced and they're launching a couple of ETFs in that space.
Yeah.
It's interesting. I recently looked at a list of what they were calling alternative mutual funds, liquid alts, and they've now started including funds that their main purpose wasn't to be alternatives, right? So with the retraction of 81-104, the quantity pools now fall into the alternative space. So you have a host of Horizons products that they're now bucketing into that same pool. And as they renew their prospectuses, that's what they're falling under. But they're not truly, that wasn't their purpose. So I think the field of products that launched starting in January under that mandate is a little smaller than they're saying, and the assets raised are a little bit smaller than what they're saying. But there's definitely interest. In the ETF space, I think alternatives or liquid alts in the Canadian space, exclude the ones that are sort of classified, is about $1 billion. So it's not bad.
It's early.
It's early.
Yeah, it's early, and there's probably quite a learning curve.
There is
to get around for advisors to start picking up on these new strategies for their clients.
Yeah, and I think it's, if you look at it, traditional asset managers looking into the space, it's them getting used to that environment. Working with primes, all things that they haven't had to do before necessarily, and then it's the hedge funds managers looking to see whether they want to get into a regulated world, which comes with a lot of costs.
Sure, a lot of oversight.
So it's the filing fees, regulatory fees, audits, renewals. Those are all things that they've never really had to worry about before. So if they're going to dive into that space, they need to be aware of the costs and obviously that they're regulated and there's rules that they need to follow a little more stringent than just putting out their investment objectives and off to the races.
Well, if they want to attract the non-accredited investors, the everyday investors, they're going to have to, right? Yeah. Ron, it's been a pleasure. Thank you very much for joining us today.
Thank you for having me.